Welcome, everyone, and thank you for joining Corporate Investing Post-Money Market Reform. Each day is bringing us closer to the October 14th implementation date of the new money fund regulations. And as that comes into focus, corporate treasurers are now beginning to finalize their course of action. Today, we will examine the regulatory impact on all money market instruments with specific attention to money market funds. We will be looking at the regulatory changes, at money market alternatives, at investment policies, and the new mechanics around investing. And that's just to name a few of the topics that we'll be discussing today. I'm Tony Carfang, and I'm a partner with Treasury Strategies. As you know, we consult with corporate treasurers and financial institutions on the areas of treasury, payments, and liquidity. I'm joined today by Ian Rasmussen, Senior Director from Fitch Ratings. Fitch is a global leader in credit ratings and research. Now, everyone who's registered for this session in a day or two will receive a copy of the presentation and a link to the recording on our YouTube channel. We invite you to visit our channel and all of the content there at your leisure. Just go into YouTube and search Treasury Strategies. We'll be at the top of the list. Should you wish to ask any questions, you can do so in the question box at the bottom right-hand corner of the screen. We'll handle these if we can. Otherwise, we will follow up with everyone offline after the webinar. Now, when we think about regulation, I think the most important takeaway from today is the fact that regulation, financial regulation, impacts every instrument and every deposit product in the marketplace available to corporate treasurers. And while we're all concerned about the regulatory impact on money market funds, as you can see here, the financial regulations have been massive, intrusive, and global. I love this slide. We first used it in June 2009 at an American Bankers Association meeting, and it has certainly proved prophetic. But now to show you how massive, intrusive, and global this is, let me turn it over to Ian to discuss actually the new landscape in the money markets.
Thank you so much, Tony. Yeah, I think that last slide very much shows kind of the major force that regulation has been, particularly in the short-term markets. That has really led to an increasing change in the landscape. If you're a corporate treasury investing cash, there's lots going on, and many of it is due to regulation. So first we have money fund regulations, and we'll get into this a little bit later, but on October 14th, there's going to be some changes to money funds. We also have Basel III, which is putting a lot of pressure on banks. And so whereas treasurers in the past well, over the last few years, have been relying on banks for a portion of their cash investing, this may be changing as banks are under pressure to review certain deposits, and perhaps certain deposits are just no longer viable for a bank. Given these two significant regulatory pressures, it's caused the industry to think about new products that they're trying to come out to the market with, which will continue to assist treasurers to invest their cash. There's quite a few of these, and Tony will go into more detail in a later slide. But I think it's very important as a corporate treasurer to make sure that at least you understand what some of these products are and how they might help you in a changing landscape. We've been in a market of very low or negative yields for a long time now, and I know that this also feeds into the decision as to where you want to invest your cash and how you're going to invest your cash. I think that this will even become more important going forward. We've already seen some trends in yields, some differentiation in products that we haven't seen for several years. And the last thing that I wanted to bring up in terms of a changing landscape is just the credit quality of investments. We've seen downgrades across many financial institutions. We've seen downgrades across corporates over the last few years since the financial crisis. And the rating methodology that's being used by different rating agencies for corporate debt, financial institutions, money market funds, these are changing. And in a large part, have limited the investable universe that corporate treasurers have. I just want to say that, we're very focused on providing information and tools, and I know that corporate treasurers have a lot going on, but you're not alone. So within this shifting corporate landscape, we hope to provide tools and help that make your job a lot easier. Tony, I know that there's still a lot going on in corporate cash and trends in corporate cash. Perhaps you want to just talk about those trends.
Sure, Ian. Well, as you can see on this particular chart, corporate cash levels everywhere in the world are at all-time highs. And the fascinating thing about this graph is the consistency of the growth in corporate cash. It continues almost on a straight line around the world. There are a couple of reasons for this. Cash is rising. From the work that we do with our own corporate treasury clients, our clients are adding precautionary cash very deliberately. Our clients are concerned about the long-term availability of bank credit. They're concerned about whether they're still going to be in their bank's target market and whether lines of credit will be available at a reasonable price. Our clients are also concerned about the reliability of the debt markets, particularly on things like the Volcker Rule or widening spreads and things like that, as well as liquidity gaps in the marketplace. And the solution for that for most of our clients is adding to their cash levels. Now, another trend we're seeing is taking advantage of these low rates, particularly at the longer end of the spectrum, things like Operation Twist or in the U.S. or negative rates in Europe are creating some what appear to be some real opportunities to leverage the balance sheet, and in the short run, that adds to cash. Now, when we think about cash, let's talk about investor utility. When you look across the entire money market, what is it that you're really looking for? And down the left-hand side of this chart, we have the value drivers that, in some combination, all of our Treasury Strategies clients list these as their key value drivers, not necessarily in any particular order, but it's high relative yield, it's liquidity, ultra-low risk, particularly for the most fundamental tranches of corporate cash, diversification, connectivity with Treasury management systems, the whole 9 yards there. And now, this list may differ for you, or some of these may be your issues, others not. But if these are, as you look across the various instruments in the money market universe, prime money market funds check every box here. Treasury money market funds check every box except for the high relative yield when you compare them to the yield on prime, and Ian has a great chart on those spreads coming up. Bank deposit accounts are also very attractive and check almost every box. Obviously, when you have a deposit with a bank, that's a single counterparty, so there's no diversification, which may or may not be an issue depending on your own utility function. But this chart sort of gives you an idea of the landscape and the relative utility of the various instruments in the money market. Now, if we focus specifically on money market funds, which seem to take an inordinate share of the discussion in the press, let's look at the variable net asset value, the fees, and the gates. And our point on slide 6 here is that the markets already impose fluctuating net asset values, fees, and gates on other instruments, and the net effect of the regulations going into effect on October 14th is really to diminish the privileged position that money market funds have held and bring them back on par with many of the other money market instruments. For example, under the variable net asset value, while most of us think of treasuries as a fixed price or agencies or commercial paper, in fact, unless you hold them to maturity, they vary in price every day and throughout the day. So there's actually a fluctuating value. If you were to mark to market every day, you would see daily fluctuations in all these instruments, just like you may see going forward in institutional prime funds. In terms of fees, well, we all know that bank deposits, if you have a time deposit and you withdraw prior to maturity, you're going to forfeit some interest, and you may pay a fee on top of that. Even the forfeiture of interest is in effect the imposition of a fee. On all other money market instruments, if you were to liquidate large denominations on short notice, you will experience a haircut. You will get some sliver, some difference between that bid-ask price, which is in effect a liquidity fee. And then finally, in terms of gates, this is a fascinating one, and subject to sort of a lot of misinformation. Banks can impose gates. It's called suspension of convertibility. Now, they almost never have used that, just like we expect money funds to never almost impose a gate. But if your legal folks are hair splitting and say, well, there's a possibility of a gate in money funds, so you can invest in them. Well, guess what? There's a possibility of a gate in bank deposits as well. The FDIC resolution process, when a bank fails, typically you have access to your funds almost without delay. However, if you check the regulation, the only requirement on the FDIC is to begin the process of planning to resolve the failed bank within 2 business days. They're not required to pay anything out in a short period of time. And in fact, the regs have no maximum for the FDIC to make the final payment. And then, my favorite story here is the market-imposed gates on auction rate securities. Some of you may remember in February of 2008, one day, one auction failed, and the entire $300 billion market froze up. That's the market imposing a gate. And in fact, there are some securities that have yet to trade since then. That's the market imposing an 8-year gate. These have been frozen since 2008. So the point here is, VNAV, fees, and gates are the realities of the money markets, and the imposition of these now on prime institutional money market funds is simply bringing them in line, not putting them at a disadvantage. In fact, if we rate the utility of each of these instruments on a scale of 0 to 100, based on all the X's that we had before, we can see the prime money market funds, before, because we could check every box, we gave it a 95 out of 100. After dodd-frank, Basel III, and money fund regs, that gets nicked down to about a 92, because there's some disadvantage that has been imposed, but Treasury money funds, direct Treasury bills, bank deposits, everyone has suffered at the hands of the regulators. So what you have is the relative utility has not changed. The ranking is almost identical before dodd-frank, Basel III, and money fund regulations as it is after. Now, of course, and this is based on our corporate client experience. You may have a different utility function. You may see things differently, but the bottom line is everything has been diminished somewhat. Now, many of our clients have done the analysis and have decided to stay in money market funds, and a high percentage stay in prime money market funds. So, Ian, what should these corporate treasurers look for as they remain invested in money market funds?
Yeah, I really like what you said earlier about relative value, and because I think in this changing and dynamic marketplace, that's really going to be a key going forward. You're not going to have a one-size-fits-all product that you can rely on for everything. There's going to need to be some decision-making. And so what we're trying to do is provide information that helps people to make those decisions. And I have a few slides that they're simply trends to watch in the space related specifically to money funds. The first one in slide 8 it's a spread chart which shows the difference in yields between government and prime funds historically. The red line indicates an average spread between government and prime going back before the crisis. You can see during the crisis, the spreads blew out as yields on prime funds increased pretty significantly. But post-crisis, those spreads collapsed as the whole market was basically trading at very, very similar yields. I want to draw your attention to the very end of the chart. What we've seen since the Fed raised interest rates in last December is that this spread has already started to increase and is now over the 20-year median spread. We expect to see this spread to continue to widen, although recently it's plateaued and maybe gone down a little bit. But as there's flows from prime assets to government assets, supply and demand should increase the spread just a little bit. And we'll talk about flows more in just a minute. Another very important metric that we're watching, and we updated our rating criteria for money funds in December with a big focus on liquidity. In the new regulation, funds, there's a threshold of 30% weekly liquidity that funds are to operate above. If a fund dips below 30%, the management is required to notify the board, and then the board needs to make a decision of allowing the manager to continue to operate the fund or to impose a liquidity fee or a redemption gate. As you can see in this chart, as we're getting close to October, managers are building liquidity, and this is happening largely across the board. You can see weekly liquidity is far higher than 30%, and we expect for this to continue. I would say if you're currently invested in a prime fund and you see that it's not around 40% currently, this may be an opportunity to ask questions about how liquidity may be growing in the future over the next few months. Now, as I mentioned, it's not a requirement if a fund dips below 30% to impose fees or gates. That's not part of the regulation. The board needs to make that decision. However, one of the reasons why we're watching this number is because we don't know for sure what investors will think of a fund that gets very close or dips below 30%. Will they view this as a problem, and will they start to pull their money out ahead of time? And for that reason, we're focused on liquidity, and in the criteria we talk about a need for a buffer over 30% for funds that are rated AAA. If you go to the next slide, this chart shows flows, and I want to spend most of my time talking about institutional flows, which is the chart on the left. You can see that there has been already flows between prime and government assets. What we've observed is that these flows are mainly due to conversions that took place earlier in the year where managers converted government funds or converted prime funds to government funds. We have not seen corporate treasurers yet in a large scale decide that they don't want to be in prime product anymore and move to government. We do anticipate that those flows may pick up some over the next few months as we get closer to October, and we think that this is also a very good trend to watch because it may inform you that your peers are getting ready to make decisions or make changes to their investment guidelines. Another important trend is just the general maturity of a money fund portfolio. Ahead of October 14th, fund managers are trying to keep the funds liquid and of short maturity. Many fund managers actually are not investing past October 14th because they just don't know in their prime funds because they don't know for sure what the flows will be. And that's what this chart indicates. The amount of securities that are out over 180 days has shrank a lot, and we think that this will continue. So if you're a money fund investor in a prime fund and the maturities are coming down, this could impact yield. If you're an issuer of commercial paper, this could also be important for you to consider because if you're rolling commercial paper and we get closer to October, you may not get the funding that you want out as to the term that you want. Also, I would note that if you are managing a separately managed account, for instance, or buying securities directly, it may be an opportunity to look into the market past October 14th, as there may be some additional value there, as money funds are less inclined to be in the markets past October 14th for prime assets. The last thing that I wanted to bring up was what we're seeing in the general money fund market, how money fund managers are currently responding to regulation coming up. So we've already talked about the restructuring of certain funds, conversions of prime to government. We also see some changes in investment guidelines for funds so that funds will start investing within 60 days or 7 days, which will help with minimizing floating NAV and also help protect against fees or gates. We've also seen a pickup in inactivity in alternative products, private unregistered money funds, ultra short-term bond funds, managers doing more to educate about separately managed accounts. And then the last trend I would mention is consolidation. We have seen consolidation within the industry, many smaller managers being bought by larger managers, but also larger managers being bought by large managers, as we saw the Bank of America money fund platform being purchased by BlackRock Asset Management. Tony, I guess, with having those trends in mind, I think it's important to think also about how these fund regulations impact investment policies generally.
Exactly. Thank you, Ian. And one other thing I'd point out on your slide about assets leaving prime funds are going into government funds, there are also a lot of assets going into bank deposits, which does create some concentration risk. As we get close to October 14th, no one is precisely sure how much money is going to move from point A to point B, or what is point A and what is point B. So you all need to be careful about concentrating too much in uninsured bank deposits as well. I'm not suggesting that you're going from the frying pan into the fire necessarily, but that there are all sorts of subtleties in monetary flows going on there. My guess is the Fed's going to really ramp up and have a lot of liquidity in the market, though, at that period of time. Now, in terms of investment policies, as all of you know, Treasury Strategies was active in the regulatory debate and opposed many of the regulations, while not opposing the principle behind the regulations, but the way the SEC was implementing. And as it turns out, there's been quite a bit of relief from the most draconian proposals. There's relief on the record-keeping rule, the wash-sale rule. We've maintained amortized cost accounting for securities maturing in 60 days or less, and we clarified the procedures for the fund boards to act in the best interest of their shareholders. And all four of these go a long way toward preserving the investor utility you saw on a prior chart. Now, one point we'd like to make, though, about your investment policies is a couple of catchphrases. First is preservation of principal does not mean that no security in your portfolio is prohibited from fluctuating at all. What it means is your portfolio has to be designed in a way that's going to preserve capital. That does not rule out fluctuating net asset value funds. Now, if you have more restrictive language that says you have to invest in a constant net asset value fund, then obviously you would need to change that. If your language simply says a 2A7 fund, well, guess what? All the new funds are 2A7 funds, so you're covered. Similarly, an objective of daily liquidity doesn't mean that every instrument in the portfolio needs to be 100% liquid every single day. It means that in the aggregate, your portfolio has to be throwing off enough liquidity to fund the corporation. If you're interested in more on this, we actually have a brochure on the topic, and if you see that email there, click at info@treasurystrategies.com, and we'd be happy to send that to you. Now, the last element in investment policies and in coming up with your asset allocation, of course, would be the credit ratings. So let me pass it back to Ian for a few words on that.
Yeah, so I think that the main theme here is this is an opportunity, or I think money fund regulation and some of the other things going on is a good opportunity to bring out the investment guidelines, review them, and make sure they reflect the current market conditions. I know many of these were written many years ago, and a lot of what's in there may not be available now or may not be available after money fund regulation. I think ratings are a part of that. We've learned through the crisis and afterwards that flexibility or options in investment guidelines can be very, very helpful, and can actually keep an investment policy fresh and make sure that you're currently investing in the way that you want to. That's the spirit of the investment guidelines. The industry best practice now is not to highlight or have to invest per a particular rating agency's rating, to use ratings more as an input to make decisions, and so therefore having broader language speaking to things such as the highest of 2 ratings or the middle of 3 ratings. There's some sample investment language at the bottom of that slide. We also think tools that corporate treasurers have been using are all, because of the changes, also need to be reevaluated. As an example of this is ratings on money funds. I think in the past, investors have looked at AAA funds as being very equal and safe across the board. But with regulation coming, there are differences in this tool, in ratings as a tool for investors to consider. As an example, the Fitch money fund rating speaks to the preservation of capital and liquidity, while S&P's criteria is a rating that speaks directly to the preservation of capital, but doesn't contemplate timely liquidity, at least at this time. And so if a fund was to impose a fee or a gate, that may not impact the rating and may still be rated AAA under the S&P methodology, but certainly under the Fitch methodology it wouldn't. And so I think in terms of investment guidelines and the tools you're using to evaluate your investments, this is a very good time to reconsider and to think about what is needed, and am I using the right tools? Do I have the right investment policies to make sure that it reflects the current market environment?
Great. Well, thank you, Ian. To summarize, in conclusion, I think one of the most important takeaways that we talked about from the very beginning was that every instrument in the money market and every bank that you deal with has been impacted in one way or another by the post-crisis financial regulation. And when you step back and you look at that holistically, it's clear that the value proposition of money market funds, and in particular prime funds, remains in a superior position for most companies based on your investor utility. But having said that, everyone needs to review. You all need to review your investment policies. There's probably some arcane language that's been in there for a long time, and you need to check it out. We at Treasury Strategies, as you know, we write investment policies for our clients. We do a number of engagements in that area, and we actually pulled 20 policies as a sample, and we found that only 2 would need to be changed in order to adjust to the new guidelines. But without looking at all of them, it would be, you wouldn't know whether yours is one of those 2 out of the 20 that we examined. So you have to take a look at it. Now, whether you need to amend your investment policies or not, we strongly recommend that you initiate a dialogue with your CFO or the appropriate board committee, because in addition to the instruments that are in your policy, the industry is developing a number of new instruments, and you want to make sure your policy is broad enough to accommodate that. And then, obviously, put in place a program to monitor the fund ratings, the liquidity, the maturities, and all the other attributes that are important to your compliance program. And then finally, call us. You know, Ian and I are here to help. Our firms work with corporate treasurers day in and day out in the short-term money markets in the area of Treasury and liquidity. So please, feel free to call us with any questions or comments, and we'd be delighted to help you. Thank you all for joining us this morning, and we look forward to hearing from you and working with you as we approach the magic day of October 14th. Thank you very much.